Hi, I'm Jessica Amir for the Finance News Network with Russell Investments High Dividend Australian Shares ETF Portfolio Manager James Harwood. Hi James, welcome to the network.
Thanks Jessica, hello.
For investors new to your ETF, just give us a quick introduction.
RDV is a very mature ETF by Australian standards. It's been around for around 8 years and it was the first equity income ETF that was listed on the Australian Stock Exchange. RDV provides advisors and their clients with above average income and exposure to the equity market. We're aiming for around 1% above the broad market, and right now that's around 5.5% yield.
James, just a little bit more detail on the ETF, including composition.
Yeah, so RDV currently holds 49 stocks in the portfolio, and they all come from the large cap part of the market. When building the portfolio for RDV, we're actually using something called a composite yield score. And there we're actually using 5 different inputs to essentially grade how good a company's yield is. We think it's really important to have multiple measures of yield. We don't just want to be looking in the rearview mirror and looking at backward-looking dividends or what a company has paid. We think it's really important to look at future dividends or forecast dividends. And one of the pieces of RDV's methodology is to actually use forecast dividends. So we take the 3-year forecast dividends from analysts for all of the stocks in the universe, and then obviously score accordingly to those that are paying the better dividends. We also look at forecast growth as well, and forecast dividend growth. We don't want to just be exposed to bond-like proxies like Telstra. Telstra's paid a very static dividend over the last few years, but it's not grown and it's seen its share price fall consequently. We also need to be exposed to the growth part of the market as well. One of the most recent buys for RDV, a big weight increase at the last index rebalance, was Fortescue Metals. The last thing is really franking credits and looking at after-tax returns. We know that a lot of investors hold RDV within self-managed super funds and they really care about franking credits. So when we're scoring companies' yield credentials, we're looking at the grossed up yield, essentially what the yield is after franking credits, and consequently RDV has a preference for stocks that pay fully franked dividends.
And James, what benefits do ETFs have in general above managed funds?
ETFs have a couple of obvious advantages to managed funds, and the first is cost. RDV, the annual fee for RDV is 34 basis points, and that'll compare to a typical equity income fund of around 1%. So if you're holding RDV over the long term, those savings can annualize and really accrue a lot to returns over time. The second point I'd make is around transparency. Any ETF is actually required to disclose its holdings on a daily basis through our website. So an investor in RDV can go to our website, download the holdings, and there's complete transparency. And that's completely different to a managed fund whereby the manager might disclose the top 10 holdings, but they certainly wouldn't disclose all holdings, at best on an annualized basis.
And James, sometimes there's a reluctance to go into new products, but ETFs have seen a massive explosion of funds under management. Maybe you can tell us about that.
The Australian ETF market is really at a different growth cycle for kind of other markets like the US or in Europe. It's still very early days for the Australian ETF market, and that's why we're seeing growth rates of things like 40% per annum. When you compare that to the US or Europe, they're much more mature markets. But we are really starting to see advisors and clients become comfortable with ETFs, and they're forming a greater part of their overall portfolio as that confidence in the product grows.
Lastly now, James, what can investors expect if they make an investment in RDV?
RDV provides investors with broad exposure to the Australian equity market and above average yields. Investors will get around 5.5% of a net yield, grossed up for franking credits, that's going to be well above 7%. That compares really favourably with the broad market, and also it's more than double what term deposits will pay investors. And I think that's important. The market doesn't actually need to go anywhere. It can stand still as it has done for the last 12 months, but because of that high yield, investors are rewarded with a return that's much better than just leaving it in cash.
James Harwood, thank you so much for the insights and for your time.
Thank you.